Hi everybody and welcome to day 3 of Not-for-Profit Finance Week. My name is Julianne Price and I'm Head of Small and Not-for-Profit Sector Banking here at the Commonwealth Bank. And I'm really pleased to be joined by Professor David Gilchrist from the University of Western Australia, who today will be our main presenter, launching a tool designed to help not-for-profit leaders better understand balance sheets. So thank you, David, very much for joining us today and for sharing your insights and your knowledge with the not-for-profit sector. We have a really large group here today. So before I kick off, I want to start by acknowledging the traditional custodians on the lands on which we are all gathering today. And for me, that is the Gadigal land of the Eora people. And I'd like to pay my respects to all elders, past, present, and emerging. As I mentioned earlier, there's quite a few people on the line, so thank you all to you who have joined. I know this is an extremely busy time for you all, so thank you for jumping on into this webinar. There will be an opportunity for questions. We'll save them until the end. So there's a box on the side of your screen where you can actually type in your questions, and I'll be sharing them with David about 15 minutes before the end of his presentation. We also better start with the traditional bank/university disclaimer. So this information that you're going to hear is general of nature. It does not take into account any of your personal circumstances. So please take it for what it is. And then I might just move on to now formally introducing David, Professor David Gilchrist, our presenter and the co-author of the new not-for-profit balance sheet resource tool, which we're really excited to be launching today. David Gilchrist is Professor of Accounting at the University of Western Australia and co-convener not-for-profits at the UWA. Welcome, David, and I'll now hand over to you to take us through the new tool.
Thank you very much, Julianne, and fantastic to be here. First and foremost, I would like to acknowledge the Whadjuk people of the Noongar Nation, on whose land I'm presenting this webinar from, but to also pay my respects to elders past, present and emerging, as well as acknowledging those First Nations people whose land everyone is occupying attending this seminar all around Australia. It's fantastic to have so many people here, and I'd like to say thanks to our community, to community directors for facilitating this not-for-profit Finance Week. I think it's a really important week, and it's great to be able to contribute to it. The not-for-profit balance sheet resource will be sent to you after this session. And I think really what I want to do in terms of my presentation is perhaps not go through the resource blow by blow, because you'll be able to see the key issues once you actually read through it, but to, more importantly, perhaps have a bit of a discussion about how you might use the resource, what the components are, and also what kinds of things are exemplified in that resource to help you to understand the balance sheet better for your organisation. I think there's a couple of things first before going through the agenda, though, that are really important for me to confirm. The first thing is that throughout this presentation, I'm going to use the phrase not-for-profit or NFPs. And I think most people that are in attendance would recognise that there's a difference between not-for-profit and charities. Charities are a subset of not-for-profits and have particular responsibilities, particularly in relation to the ACNC and also to their regulators like ASIC or state associations regulators. All of this resource is focused on not-for-profits, not necessarily charities or a particular subgroup of those not-for-profits. And so I won't use the term charities when I go through this. I think the second thing to remember too is that in relation to this resource, what we're looking at is trying to build a resource that actually is able to be used in a management scenario as opposed to a reporting scenario. And I'll come back to that a little bit more later on, but it's important to remember that when I'm talking about this resource and going through the examples and so on, at the end of the day, the resource is not a compliance resource to assist you in achieving compliance, but rather a resource to assist you in managing your balance sheet much more effectively within your organisation. I think the third thing that is really important to remember too is that, historically speaking, often not-for-profit organisations have focused much more on their profit and loss report or their income statement than they have on their not-for-profit balance sheet. And this has been for a number of reasons, but primarily it's been driven by the fact that government funding arrangements have often focused on acquittal processes and focused on profit and loss from a sustainability perspective. The balance sheet really has faded into the background, leaving profit and loss as being the primary statement that people look at. With the change in the way government funds services, particularly in relation to what we call quasi-market funding arrangements, like that under the National Disability Insurance Scheme or in aged care, where we have client-centric services and user choice and control, the balance sheet is becoming a much more important tool for organisations to help them to be able to ensure their sustainability going forward. And I will also talk more completely about my conception of sustainability and how we might treat the balance sheet in that context. But I do think it is important to recognise that this tool is probably very timely in the sense that the balance sheet is becoming more and more important. And in fact, I must admit, I got goosebumps thinking about that conflation of the timing of this report with the conflation of things like the National Disability Insurance Scheme and the aged care changes and other changes that are occurring to funding for not-for-profit organisations around Australia and undertaken by most state and governments as well as the Commonwealth Government. So before we go further, the agenda for today then really is for me to discuss with you about how you might use this resource, what kinds of things you might use to emphasise it and how you might inculcate that in your organisation. I'll then have a look at the discrete sections that the resource is divided up into, which include a description of the balance sheet itself, a description of cash and cash management in the context of the balance sheet, a description of asset replacement, decision making and how you might approach that, and then of course cash flow budgeting and financial planning. At the end of the day, of course, cash is a very big part of the balance sheet management process, and organisations need to consider cash in that context, and we'll come back to that shortly. Before I go any further, I'd like to also express my thanks to Commonwealth Bank for supporting the development of this tool, and I think it's been a very prescient tool, and as I said before, a very timely tool. So having Commonwealth Bank be able to resource this and to make it happen and work with us so efficiently and effectively to get this tool developed so quickly is a real pleasure, and I appreciate that very much. I'd also like to acknowledge those sector leaders who contributed by providing their input into drafts of this report as it was developed. The important thing about this report or this tool is that it's not actually a tool that is designed to expand our knowledge around accounting per se, but rather designed to be a tool that can be used predominantly by people who are not trained in accounting and whose first love is probably not finance. Therefore, I think it's really important to have that sector input to make sure the language and the balance of information for utility is maintained. I'd also like to acknowledge my colleague, Dr. Dane Etheridge at Curtin University, who's my co-author in this tool, who also provided great insights and supported me in getting the tool published, which is fantastic and much appreciated. Okay, so let's get into it. First and foremost, how to use this resource. And we've already had the traditional disclaimer, and I think that's a great device to describe that with. But it is important to remember that this tool is not intending to provide advice. And indeed, really, it can't provide advice because the sector is not homogenous, as we all know. Every organisation is different. It has a different starting point, a different board with different skills mix, and so on and so forth. And therefore, it really is important for people to recognise that however large this tool was, it still could not be all things to all people. And therefore, I'm very, very keen for you to recognise that this is not intended to be advice, And indeed, it is really a contribution to understanding rather than an advisory process. The second element is that this tool has been developed for a particular audience in mind. The audience we have in mind include voluntary directors, CEOs, and other senior people within not-for-profit organisations around Australia. To that extent, we've not aimed this document at accounting professionals, because really accounting professionals probably are across most of these things. However, at the end of the day, it is important for CFOs and accounting professionals within not-for-profit organisations, and also auditors and others who are serving not-for-profit organisations, to become familiar with what's in this resource in order to help them to be able to convey ideas and issues that they want to convey to their boards and to their clients. The other thing that is important to remember is that, as I mentioned before, the not-for-profit sector in Australia is not homogenous, and indeed many organisations have different accounting systems developed to various maturity levels. By and large, those accounting systems would be fit for purpose, depending on the size, the turnover, and the risks associated with a particular organisation. Having said that, predominantly this tool looks at accrual accounting systems and discusses the balance sheet in an accrual accounting sense. Now, accrual accounting is also discussed more fully in the tool to give people an understanding of what the definition is as we use it in that context. But it's important to remember that accrual accounting means that we effectively look at not just what cash flows have come in and out of the organisation, but what is the position and performance, if you like, in a legal sense too. So what does the organisation owe and what is owed to the organisation? Having said that, it is always important, as I mentioned in my prefatory remarks, to ensure that we continue to look at cash and cash flows within an organisation. And indeed, those organisations that still operate using cash accounting, that is, that they only account transactions when cash changes hands, would still find a lot of the tool useful and I hope interesting in terms of making sure that they have a list and an understanding of the assets and liabilities that are associated with their organisation. This might also lead them into establishing accrual accounting in their organisation, but that's not necessary, and the tool is not intended to promote accrual accounting, but rather to promote knowledge of finances and the financial position of your organisation within the board and within the CEO, the senior staff that manage it. The other thing that we've added to the tool, and I think is a really important initiative, is the inclusion of focus questions at the end of each section. And the focus questions are intended to be able to support the board and CEO and others to be able to ask basic questions that are relevant to each section and to ensure their organisation has covered off the key risks that have been identified. Some of those questions may not be relevant to all organisations, and it's really up to you to discern whether or not those questions should be asked within your organisation. The final point that I think is really important is that we've added a glossary, and the glossary is important because it helps people to understand the definitions of the terms and the phrases that are used within the tool, but more importantly, we've also tried to, if you like, simplify the tool so that those phrases and terms used are defined in a way that's particular to the tool. Hopefully, it's not much different to the way they're defined in the broader accounting community, but we have tried to be very specific and tried to simplify that set of definitions. And so I think it's important for you to look at the glossary and use that in your discussions, not only in relation to the tool, but that glossary might be useful for your discussions more broadly about the financial management of your organisation. The final point, and I think the important point, is that of course you need to get advice in order to ensure your organisation's balance sheet is being managed as effectively as possible for sustainability going forward. And we can always talk about that. There is a lot of differentiation between organisations, and so it is very legitimate for boards and others to get advice to help them through that discovery process and also through the governance of the balance sheet itself. So what does the resource actually do? Our intention for the resource is that it describes the purpose, nature and governance of the balance sheet itself. What is the balance sheet? How does it work? And what are, I guess, the accounting specific issues that accountants always look at in the context of the balance sheet. How might we use the balance sheet in our organisation? As I said before, it's focused on those untrained in accounting, so hopefully it is written in a way that speaks to people that are not finance specialists. And as I also said before, it does contain some key focus questions that I think are really important for you to consider in your board situation and also in the executive of your organisation. Most importantly, though, this report or this resource is actually a starting point. And so you should really start with this resource and move forward in terms of understanding your particular balance sheet and your organisation more fully as a result. Let's have a look at the structure of the resource itself. First and foremost, we have, as I said, 4 sections. And the first section looks at the balance sheet and describes what the balance sheet is. But most importantly, it describes it from the perspective of what risks the balance sheet entails and reports on, and what governance arrangements might be put in place in order to better manage those risks and monitor those risks. Again, I won't be going through this in great detail because we don't have the time to do that today, but it is worth going back to looking at the tool and considering the description of the balance sheet in that context. It's a report that helps management and those charged with governance understand the risks that they face in a financial sense, to be able to manage those risks and monitor those risks. Section 2 talks about cash, and as I already indicated, cash, of course, is absolutely critical to sustainability in any organisation in a modern market economy such as that of Australia. Not-for-profits are no different, and so being able to deal with cash does take out of the balance sheet a fairly significant section and focus on that section, but at the end of the day, it is an absolutely critical aspect of the operation of any organisation to maintain sustainability. We also have a section looking at the asset replacement decisions that organisations might make. And we make some suggestions about how organisations might make those replacement decisions and what kind of risks they might be able to identify in the context of the assets that they deploy in trying to achieve their mission. Again, this is, if you like, taking out of the balance sheet or focusing on some particular sections of the balance sheet, but I think important sections for people to consider. Finally, we have a look at section 4 in financial planning, and I'll get to this in more detail at the tail end of the presentation, but suffice to say at this point in time that the balance sheet is a static point-in-time document that describes the assets and liabilities of an organisation. Often we term the balance sheet as a report on the net wealth of the organisation, for instance, and that's fine. But we also must learn to manage our budget and forecast our balance sheet more effectively. As I said before, in terms of the traditional financial management of not-for-profits in Australia, many organisations have focused on profit and loss reports rather than balance sheets, and this extends to budgeting and financial planning. And so in section 4, we look at how you might mitigate that, how you might change your practices to better plan your budget, your balance sheet, and to better forecast your balance sheet. Okay. So first and foremost, the balance sheet, as I said before, is a report that is a snapshot at a point in time of the assets and liabilities of an organisation, and in effect, if you like, demonstrates the net wealth of that organisation. It helps us to understand the sustainability of the organisation, but there's a few mitigations or a few things that I want to talk to there. First and foremost, this tool focuses on what we call a management balance sheet rather than a reporting balance sheet. In other words, the management balance sheet can be developed any way that the board and the executives of an organisation wish it to be developed, such that it helps them understand better the assets and liabilities of their organisation and helps them to plan better. In other words, the management balance sheet is not a document that has to conform with any external reporting requirements. On the other hand, the reporting balance sheet is part of the suite of financial reports that are published after audit on an annual basis and which stakeholders outside of the operation of the organisation often use to make decisions relating to. That balance sheet is not an ad hoc balance sheet in the way the management balance sheet is. It must conform usually to the Australian auditing standards, the Australian accounting standards, and auditors usually look at that balance sheet in the context of auditing standards and how that balance sheet represents the position of the organisation, and particularly whether that represents the position of the organisation in what we call true and fair terms from an accounting perspective. We're not interested in this tool or in this presentation in the context of the audit process or in reporting the balance sheet. We're interested in creating a management balance sheet that best serves our need. The second thing about balance sheets are, and most people are probably well aware of that, is that we have a tendency to divide up the assets and liabilities between what we call current assets and non-current assets, current liabilities and non-current liabilities. A current asset or a current liability is an asset or liability that is going to convert to cash in some way, shape or form, or be used up within the next 12 months. Whereas a non-current asset or a non-current liability is going to crystallise, become cash or be used up at some period beyond that next 12 months. Therefore, this is a very important dichotomy, a very important way of allocating assets and liabilities from current to non-current, but equally it's also a very simplistic way. And I'll come back to make some statements about current versus non-current assets and liabilities shortly. The final point I want to make is that this tool is all about sustainability. It focuses on sustainability. And the balance sheet, as I mentioned before, is fundamental to being able to maintain sustainability toward mission of your organisation. So what does that mean? It means two things. Number one, that when we talk about sustainability in the tool, we're not necessarily just talking about the survivorship of the not-for-profit corporation itself. It's the survivorship of the corporation in being able to pursue its mission, to do the things it needs to do. And I think the management and forecasting of the balance sheet is an important part of the way those charged with governance, CEOs and others, are able to assess that sustainability. To that extent, sustainability means three things in three different time regions. In the short term, when we talk about sustainability in the context of the balance sheet, we're talking about solvency. And most directors, quite rightly, are concerned about this because it's really the situation where you want to make sure you have enough cash to pay your bills when they are due. If an organisation trades insolvent, or if it's not solvent, that is that it runs out of cash before it's able to pay all of its creditors or to pay all of its obligations, then directors can be personally liable for the outcomes or losses incurred by those people owed money. And therefore,
Hi, David. We've just briefly lost your sound here for a moment. Just bear with us one moment, guys, while we sort this out. Sorry about this.
Hello?
Hi, David. Yeah, we've got you back on now. Thank you for that. Sorry, everyone, about the delay there. We had an issue with the audio. David, someone has kindly let us know that you lost your audio when you were defining solvency. So if you're able to pick it up from there, that'd be good to go. Thank you.
Very happy to do that. So solvency, as I've already defined, but to get back into stride, is that process or that capacity to be able to pay your bills as and when they're due. But of course, in the mid-term, sustainability is also important. And in that regard, that relates to the organisation's mission and its capacity to be able to continue to provide the services that meet the quantity, quality and timing required in accordance with that mission. In other words, in the mid-term, you need to be able to recruit clients, you need to be able to advertise, you need to be able to train and recruit staff and retain staff in order to continue to be able to develop that mission centricity. In the longer term, sustainability is also an issue, and the balance sheet really comes into play in terms of that mid-term and longer term assessment of sustainability for your organisation. In the longer term, you have to be able to replace assets. You have to be able to invest in your organisation to meet the changing circumstances that apply, and this includes in terms of change management, in terms of investing in staff and infrastructure, and also in the modern parlance, to be able to invest in things like mergers and acquisitions and invest in growth in your organisation. All of these things are relevant to the management of the balance sheet, and your ability to do them is absolutely contingent on your ability to be able to maintain a working balance sheet going forward. Okay, so in terms of what the balance sheet tells us, there's, I guess, an additional element that's really important here. And again, these kinds of categories of assets and liabilities might be things that people are already well aware of, but it's worth just running through to make sure that we're all on the same page. Essentially, as I mentioned it previously, the balance sheet is generally identified or described as the snapshot of the net wealth of an organisation at a particular point in time. And to be able to understand that, we talk about assets and liabilities, current and non-current, but we also talk about accounting estimates. And these are important issues that I'll talk about much more deeply shortly. But for you to be aware that not only do we think about cash, buildings, motor vehicles, not only do we think about creditors, employee annual leave and other entitlements, loans and those kinds of things, they're all typically understood to be assets and liabilities. We also need to consider things like depreciation, as well as employee leave entitlements that are going to be taken, accrued over a longer period of time and taken at some point in the future. We'll talk about that a little bit more, but from a sustainability perspective, these are really important things to have in your mind, even if you traditionally account using cash accounting rather than accrual accounting. You need to have a list of these assets and liabilities in order to ensure your organisation meets them when they're due. Okay, so in terms of sustainability and looking at the balance sheet, there's some basic rules that are really important to consider. The first one is that we have a tendency to say that we would like to see more current assets than current liabilities. And that makes sense. We want to make sure that cash, debtors and other current assets outweigh our current liabilities so that we're able to pay those current liabilities and, for want of a better term, have cash left over for working capital. And the second thing that's important is that we want to have more non-current assets than non-current liabilities. For the same reasons as I mentioned before, suffice to say that we don't like to mix current and non-current assets and liabilities and have, if you like, cross-reliance. In other words, we don't want our current assets to be supported by non-current assets to meet our current liabilities, because we're essentially selling the farm in order to make things work. Final point here that is important is in relation to profit. Now, we discussed profit in last year's presentation when we talked about governance of not-for-profit organisations, and it's really important to remember that not-for-profit organisations are called not-for-profit because they're unable to distribute profits to members. They're not intended to not make a profit, and indeed, to be sustainable, to build a balance sheet, profit is part of that capacity. Your balance sheet will not get stronger if you don't create profit. However, there's a couple of things about that that are important. The first one is that in relation to timing, while we like current assets and current liabilities to balance off each other, and while current assets and current liabilities are those elements that are going to come to crystallisation at some point in the next 12 months, in reality, timing is much more critical than just understanding that next 12 months. For instance, if we have a set of current assets that are going to crystallise at the end of this month, but we have to pay some current liabilities before the end of the month, then we need to have cash in the bank to be able to pay that. In other words, we need to have working capital, and that timing is a critical aspect that those charged with governance, directors, CEOs and others really need to be aware of. The second issue is that when we talk about sustainability, non-cash items like prepayments and payments in advance or income in advance are really important considerations. We need to, if you like, remove those elements from non-current assets and current liabilities, current assets and current liabilities in order to judge our cash flow requirements. But we also need to ensure that where prepayments are made, we're getting full value for those prepayments, and where income is received in advance, we're able to deliver on those services at some point in future. The final point that I want to raise in this section relates to accounting estimates. And this, in many respects, is often a little bit more difficult for non-accountants to grasp because it's a little bit more technical accounting, but let's go through it and hopefully make sure that people are comfortable with this area. A balance sheet presents the accounting estimates, which relate to things like predominantly future expenditure. So in the case, for instance, of employee entitlements, I am employed at UWA, I will get long service leave and annual leave at some point, but I would not have earned that long service leave until I actually stay in employment for a certain period of time. However, over the time that I'm serving the organisation needs to estimate how much my long service leave will cost and maintain that on the balance sheet. This helps the organisation in two ways. Number one, it helps to make sure that the leave is taken as soon as it is accrued, and that's really important because, as we all know, leave is paid at the future rate of payment, not at the current rate of payment, and therefore the longer I take before I take my leave, more likely the more expensive my leave will be to the organisation. The second thing is, of course, that the organisation needs to make sure that it has sufficient resources to pay out that leave. In other words, to make sure they have sufficient resources to pay out those accounting estimates going forward. If they haven't, then that will lead to a sustainability and a solvency issue at some future point in time. So long service leave and leave are really important considerations. The other consideration is depreciation. And often people treat depreciation as if it is simply an accounting adjustment or some accounting element that doesn't really affect the financial outcome of an organisation. But in fact, depreciation is an estimate of the consumption of an asset. And so if you're not depreciating your assets, you won't understand how much resource you're consuming to deliver a service, and therefore you might not be able to better tender for your services or make sure all of your costs are covered. Even if depreciation is not covered, it's important for the board and for CEO and others to appreciate and understand, if you like, intellectually, what the gap is in the cost compared to what the price being received for a particular service is. Absolutely critical that depreciation as an accounting estimate is included in that costing process. So at the end of the day, the risk in the balance sheet is, and there are a number of risks in the balance sheet. One is that the balance sheet does not disclose the full potential costs associated with your organisation, and remembering that those potential costs become actual costs at some point in time, and therefore you're coming to a point where you will crystallise those costs and need to be able to pay them using cash. The second issue is that you need to have governance processes in place in order to be able to mitigate and to manage these processes and to manage the balance sheet more effectively. So things like reporting leave balances to the board, and particularly overdue leave balances, is a really important control for organisations to have to help them to be able to manage that leave effectively. You might even find, for instance, in that regard, that it's really useful for the board to develop a leave policy that instructs staff as to when they can take leave and when particularly they should take leave in the context of when it's accrued. Further balance sheet issues that are important for people to consider include valuation. So the balance sheet, as I mentioned before, is a snapshot of the wealth of an organisation, the assets and liabilities. But the value of those assets and liabilities can change over time, and typically, particularly with non-current assets, we find that the valuation can be misrepresented on the balance sheet because the asset has been on the balance sheet for a long time. It's really the director's responsibility, working with the staff of an organisation, if you have staff, to be able to establish a valuation of those assets on your balance sheet that is reconciled, if you like, with the true valuation of those assets. Organisations can use replacement value, they can use the market, so motor vehicles, resale value and those kinds of things, or they can simply ascribe a value related to the income generation that particular assets might contribute. It is a relatively complex area, but making sure that not only have you captured everything on the balance sheet, but that you have valued everything properly is a really important issue. The timing is also an important issue. We simply, as I mentioned before, breaking up the balance sheet between current and non-current elements is a relatively simplistic view because it really says, okay, what's going to become crystallised this year and then what's going to be crystallised beyond that. The timing of the crystallisation of assets and liabilities, though, must be more precisely known, and the balance sheet should be forecast in order to be able to identify that. What you don't want to be is in a situation where non-current liabilities particularly sneak up on you and become current liabilities before you've realised, and you have insufficient cash in place to be able to manage that process. Completeness, so making sure you have all of the elements in place, is absolutely critical too. So at the end of the day, the risk that the balance sheet does not disclose the full liabilities is a risk that's important to consider. Additionally, not disclosing the full assets is also a major issue. Not across sustainability issues over time is a third risk that you should consider, making sure that you appreciate that you might be sustainable and solvent today, but over time that situation might change, and the balance sheet helps you to understand that. The second issue or set of issues that I think are really important is being able to identify balance of administered assets versus controlled assets. The not-for-profit sector and the public sectors are two sectors that are very different to commerce in the sense that assets can be divided between administered and controlled. You have a philanthropist provide you with a motor vehicle, and the motor vehicle might come to you with very significant mitigations about how you might be able to use it. In fact, you might not be allowed to use it for other programs, you might not be able to sell it or realise it. And therefore, on the balance sheet, you want to be able to separate administered and controlled assets. Controlled assets being those assets that you can sell or do with as you wish. You need to be able to separate these two conceptions because if you don't, you might miscalculate what your assets contribute to solvency. Obviously, if a philanthropist provides you with a motor vehicle and you're not entitled to sell that motor vehicle, you must hand it on to another provider. In the case that you don't undertake those activities anymore, then you can't use that motor vehicle's cash value to help you with your solvency. You might also misuse assets if you don't understand that those assets are administered. So again, if the philanthropist says you can only use a motor vehicle for a particular thing and you apply that motor vehicle to other activities, then effectively you're misusing that asset and potentially breaking contractual arrangements that might be put in place. We're moving very quickly here, but there's a lot to go through. The mitigation is in your balance sheet, management balance sheet, actually split the controlled and administered assets for better reporting and better understanding. At the end of the day, ratio analysis is also used quite predominantly to be able to support the analysis of your balance sheet. It's important to remember that with ratio analysis, these ratio calculations really only identify areas of further interest. They're not an answer in themselves. And so to that extent, they really are a pointer. They might miss areas of concern, and you need to understand the full impact of the nature of your balance sheet, not just the ratio analysis itself. We have two types of ratios. We have commonly used ratios, and the tool lists those commonly used ratios in the appendices, so you're able to use those and calculate those. But we also might need in our organisation, due to the lack of homogeneity from organisation to organisation, a set of ad hoc ratios that better serve our outcomes and what we're trying to do. So to that extent, directors, CEOs and others need to both understand ratios and how they're used, and also understand the relationships between the figures on their balance sheet and across their financial reports in order to manage or develop ad hoc ratios that might better be used to pinpoint problems that you have. As such, it's really important for you to mitigate this process by, if you're using ratios, developing ratio targets. In other words, targets that you're trying to achieve using those ratios to give you an understanding of how closely you've got to that target. At the end of the day then, the balance sheet risks and governance are really important for your organisation to consider. In this panel, you can see a number of examples that are provided in relation to key elements that are often represented. Cash, debtors, inventory, creditors, and PAYG, BAS contributions are really important things to think about. As I've mentioned many times throughout this presentation, cash is king. Cash is absolutely critical, and therefore an organisation needs to understand its balance sheet in the context of cash, and you might use the quick ratio and also cash flow budget to help to govern that process, to understand that process better. Of course, the risk is that you don't have sufficient cash to be able to meet the outgoings of the organisation. In terms of debtors, so those people who owe you money, the big risk is that those debtors don't pay. And again, ratio analysis is used to help you understand that critical element in your balance sheet. But we also use aged debtors reports to be able to explain to the board and senior management who hasn't paid and how long it has been since they've paid. You might also use what we call the average debtors to get a sense of how long it actually takes for debtors to be able to pay you. And then finally, these things inform the cash flow budget, of course. Inventory is also a big issue for a number of not-for-profit organisations, particularly because they often get stuck with stock that is unable to be sold. In other words, it's no longer relevant, and they often value incorrectly the value of that stock. So when you're trying to govern that aspect of your balance sheet, you need to think about the stock turnover ratio, and again, these inform the cash flow budget. Creditors are those people that actually owe you money, and of course there's two things, that you owe money to, and there's two key risks associated with creditors. The first thing is that creditors might be understated. In other words, you haven't captured all of the creditors that are relevant to your organisation. And this is particularly so where people adopt cash accounting rather than accrual accounting, where you might not have a list of creditors and you might not be managing your cash effectively to ensure you're able to pay them. And of course, the risk is that you become insolvent because you're not paying your creditors. To govern this, we often use the creditor's average payment period as a board to understand whether or not creditors are being paid within board policy, so it might be 30 days or 14 days. And also we use the age creditors report to help us to understand that as well. Perhaps the most important thing here, though, is the PAYG and BAS or BAS statement remittances to the ATO. Why I say this is important is because PAYG and BAS amounts owed to the ATO are sheeted home in terms of responsibility to directors automatically, similarly in the way that solvency becomes an issue for directors to deal with. And so ATO not receiving payments places not only the organisation in financial jeopardy, but places directors in potential financial jeopardy as well. How do you govern that process? It's important, I think, for directors to regularly review what's called the integrated client account from the ATO and have that tabled, which allows you to see what amounts you owe and how quickly you're paying those amounts. Again, the regular review of the integrated client account and the consideration of PAYG and BAS arrangements inform the cash flow budget as it's created too. Okay, so let's have a quick look at cash, and particularly thinking about cash in the context of what we call working capital. And working capital is the amount of money that you need in your bank account to be able to pay your staff and creditors while you're waiting for clients or funders to pay you. And this simple diagram demonstrates that what is in effect a circular arrangement. So you provide a service, you have to pay your staff for that, you have to pay creditors for supplies and other things. You, in the meantime, have invoiced your clients or the funders, and ultimately they pay, which replenishes your cash balance. So you can see that cash balance over time in that graphic representation below. The working capital requirements equal the total amount that you need to hold in your bank account in order to be able to meet those payments before those people who owe you pay you. It is a really critical aspect of an organisation's work, because if you have little working capital, you're in solvency challenge, and if you have too much working capital, you're not being efficient in terms of the use of your cash. So in that regard, it's important for directors and others to consider the planning of the balance sheet in the context of developing target cash levels or reserves. It's also important to ensure that in relation to those reserves and cash levels, that the board receives reports on the outcomes that are actually achieved. It's also important, as I said before, to maintain profitability, to be able to build those reserves, and also to ensure that your current cash flow needs are understood so that you can maintain solvency, while also ensuring that you have sustainability capacity for ultimately for replacing assets. Investing in the organisation for sustainability is also critically important, and ultimately, of course, cash is king in the context of being able to ensure this organisation can move forward to maintain its mission. What is also important here for you to recognise and to remember at all times is that when you hold large cash reserves, you also have to report those cash reserves in the context of financial reporting obligations. And so at the end of the day, it's really important for you to consider how you describe those cash reserves so that philanthropists and others don't make the mistake of thinking that you have more cash than you need and therefore you're not in need of their assistance and support for your programs. Okay, so section 3, I'm mindful that we've got a limited amount of time left and we do want to leave some time for some questions. Asset replacement is a very, very important element, and part of your planning for your balance sheet includes how you're going to replace the assets that you might have going forward. You need a short, medium and longer term horizon, and you need to consider where the cash comes from. And so your financial planning horizon, not your budgeting horizon, should really be a 5-year horizon. The principles that you might use to make asset replacement decisions are also covered in the tool. And they look at these 5 general principles, which will have in no particular priority order, but which might have a priority order from your perspective in terms of how the organisation operates and the issues that it has to face. But essentially, assets need to be replaced when they become unserviceable, when they become unreliable, when they might cause the loss of accreditation. In other words, they're no longer fit for purpose for the particular service, where you change your services and so there is a loss of applicability, and also where you might have high risk assets, so where the failure of an asset might impact health and safety of staff and or clients. You need to understand each of your assets and how they slot into those replacement principles in order to make appropriate policy and to make appropriate arrangements for the replacement of those assets within a timely manner. Finally, in terms of cash flow budgeting and financial planning, as I mentioned, budgeting is well established in this sector, but financial planning, I think, is less so. The development of a financial plan over a minimum of 3, but I think a maximum of 5-year horizon is critically important, and that includes in terms of ensuring you're budgeting your balance sheet over that particular period in time. How do the components of financial plans work from a time perspective over the short, medium and long term? As you can see there, the annual development of an operating budget, cash flow budget and capital budget is absolutely critical. It then informs the asset reinvestment plan, the employee entitlement estimate, also loan capital repayments over the medium term, and then ultimately informs the financial plan over the longer term, which helps you to maintain your sustainability in those 3 temporal periods. There are questions there that help you to ask the right question in relation to governance over these elements, and I'll leave those to you to look into. For the last 5 minutes, though, I think we will progress to questions, and so to that extent, if we can hand back to yourself, Julianne, I'll let you take over.
Sure, we do have some questions here, David. The first one is from Olivera, It's often hard to get people to take annual leave and long service leave. Management often say that there's no time to take that leave off. Any thoughts on how to encourage leave to be taken so that it's not a burden to the organisation in the long run?
Absolutely. So the first governance element that should be developed is a policy around leave, and the policy around leave should include when staff have to take leave, and of course it should be introduced to staff when they begin employment with an organisation. In the case of staff in situ, it is important to continue to communicate to staff about the criticality of them taking leave and to not allow for precedents to be built up where people are allowed to accumulate leave for whatever reason. There might be situations where people want to go back to their home country, for instance, on an extended visit or something of that nature, and the policy can actually accommodate those kinds of things. But being able to develop a policy and enforce that policy is a really important part of governance for a CEO.
Yeah, it's also good for our own personal sustainability as well. So I'm sure it leads to increased productivity in the long run.
Absolutely, I think that's exactly right. It's an health and safety issue for sure.
Next question's from Angela. David, would you have any suggestions about appropriate depreciation thresholds for medium-sized not-for-profits?
That is the million-dollar question. At that end, what level of profit should we generate is the other million-dollar question. I think there are some ways of calculating that. So I can't give you a discrete and defined depreciation rate because different assets are depreciated in different ways, and often organisations start with the tax position and move from there. But I think you need to forecast the utility of the asset and to be able to depreciate that asset against that utility going forward. In other words, if it's a motor vehicle, a safe motor vehicle will have certain attributes. And once those attributes are no longer present, so the car's not reliable, it might leave people abandoned in the country or something like that, which you don't want from an health and safety or a client safety perspective, then you need to be developing your depreciation schedule accordingly. In other words, what is the replacement decision that needs to be made and the attributes of that asset in the context of replacement, and work backwards in terms of the depreciation.
Okay. Just two more quick questions, I think, David. One from Peter. Does the value of outstanding leave need to be updated each time the employee salary increases in order to accurately reflect the value of non-current assets?
Absolutely. So there's the leave liability on the balance sheet in the best scenario, and remembering that this is always an issue of materiality and the capacity of the organisation to afford to make those changes. But at the end of the day, the leave balance on the balance sheet should represent the cost of leave had it been acquitted on the day of the balance sheet being drawn up. And so that means it should change every time. What a number of organisations are doing, and increasingly organisations are taking this on board, is that they're building what we call cashback reserves for employee entitlements. In other words, they're building cash reserves so that when people take leave, they can use that cash rather than operating cash and trying to cash flow it on a day-to-day basis.
Okay. The next question is from Angelo. For non-current assets owned outright, how often should the organisation carry out valuations?
That is also a really important issue. I think there's two things to consider. The first thing is that when I'm talking about valuation in the context of this tool, we're talking about valuation from the perspective of internal management, not external reporting. So we might have a different view of external reporting in terms of valuation of assets because of the nature of the accounting standards and what our auditors would require. So I think that's the first thing. The second thing is, if you build on that suggestion that there is a difference between the management balance sheet and the published balance sheet, then the valuation needs to be such that the directors feel very comfortable that that valuation can be achieved if that asset is actually sold or has to be realised in some way. And often a fire sale valuation is a better valuation than an open market valuation for solvency purposes. The third element is that depending on the size of the organisation, probably every 3 years or so, you should have an external valuer value those assets. So in the case of, say, an aged care operation, it might be useful every 3 to 5 years to have a valuer come in and value the facilities and provide that sworn valuation, which will help you not only understand the true value of your facility, but also help you to report externally in relation to your balance sheet as well.
Okay. David, this will be the last question. And for the questions still coming through, David has offered to answer those questions offline, and we'll share those answers with everybody on the call. So thanks very much, David. The last question for the webinar, though, is from William. What is the difference between the annual operating budget and the annual cash flow budget?
So if you are an accrual accounting system user, that is, that you have a full accounting system in your organisation, you don't just budget for the cash in and cash out. You actually budget for when you incur the expenses, and you need to then budget your assets and liabilities in that context. So, for instance, what are your debtors going to be, and when are they going to pay? So your cash flow budget is simply budgeting when the cash actually moves in and out of your bank account in order to make sure you have sufficient cash to be solvent. Your budget, your operating budget or your annual budget, relates to all of the costs and when you incur them, even in relation to things like depreciation, and those other accounting estimates need to be included in that budget process.
That's great. Thank you, David. And thanks for a great session and for your patience around our technical challenges, as I think we're all becoming accustomed to as we move to this world being our norm. But thank you for demystifying the balance sheet and also highlighting how important it is to tell that story around sustainability. And thank you also for all of your help in developing the tool, which I know will be an extremely popular and highly valued tool across the sector. So thank you, David, for all of your efforts and for everybody who's helped contribute to the development of that tool.
Thank you.
So everyone on this call will get a copy of that tool, that'll be emailed through to you from our community. We still do have 2 more webinars this week. Tomorrow is with our Chief Economist, Stephen Halmarick, and that is an update on the current state of the economy. And then on Friday will be a session on innovation, so rethinking success using innovation, and we're looking at design thinking to help manage through change, which all of us are experiencing at an intense pace. And we'll also take you through a couple of case studies where using this process has helped a number of not-for-profits actually get through the change that they're currently facing. So hopefully for those of you who are interested in those topics, you'll have some time to jump on the webinars. We've also launched the Treasurers Awards, and that launched yesterday. If you go to our community website, every nominated treasurer gets a certificate of appreciation, and there's also an opportunity for treasurers to answer a question for the chance to win one of 4 $5,000 donations. This week, we also launched our 5th guide in the series of guides, a damn good advice guide for chairs. So if you are a chair of a board, or if you think your chair might be able to benefit from a guide, please reach out to our community website again for a copy of that, where you'll also find a great resource, Save Our Sector, which is a tool that our community commenced at the beginning of this COVID period to help our not-for-profit customers and all not-for-profits around Australia navigate through the challenges that COVID has presented to the operations of our not-for-profits. So thank you, everybody, for joining us. We really appreciate your contribution. And thanks again, David. Wishing you all a good afternoon. Until next time, goodbye.
Thank you.